you've studied the Fed over 20 years. What would you tell them?
You have to take a view on the tariffs, right? Currently, I think the anxiety that exists among consumers is that it's not clear what will happen. And the Fed has a role to play there because it must guard for price stability. How do you do that? Is by controlling expectations. And by how do you do that? By very clear messaging.
Welcome to another episode of You're in Business. I'm thrilled to say that we're joined by Ben Emmons. He's the Chief Market Strategist at Strategic Fort Wealth, the founder of FedWatch. Ben, great to have you on this new show.
It's great to be on with you, Youssef. It's great to see you again. Thank you for having me.
I think the big question really is around tariffs. We'll get into some of the Fed dynamics in a moment. But from your years of experience in the industry, would you say that they actually can work, or because everything I've looked at suggests that they don't really work?
Yeah, that's the reciprocal tariff, right? Where they're basically going to match most of the other countries that have tariffs much higher than we have. It would be an end of the global trade era if we know it. That could be because the US has always been this low tariff country with a huge trade deficit. And a lot of countries do a lot of trade with US, so that's, I guess, going to change, at least to an extent. So that's significant. As you think about tariffs, so the Trump administration, President Trump himself, has been very strong about a tariff economy. As McKinley, president back in I think it was in the 1700s and 1800s, literally managed the economy with just tariffs. You don't even need to use interest rates. You just use tariffs because they're flexible too. You can increase or decrease them in any moment in time. And you can, create therefore very quickly policies that affect the economy immediately. So in that regard, they do work. And we can tell, right? Because if you really see the data coming out, whether it's import prices, whether it's business outlook, whether it's consumer confidence, tariffs are already having an impact without actually being implemented. They're just being announced. Right? So yeah. I think they're a very flexible, effective tool for that perspective. But they're put it in a very negative context. People are very negative on tariffs. So it would be interesting.
So you're saying that tariffs should be given more credit than sort of mainstream debates have allowed so far. Is that right? You're saying that yes, even though a lot of examples exist where it didn't work, there are examples where it can work. Correct?
Well, if you take all the other countries that have much higher tariffs than we do, and you look at their GDP growth, there are some cases the GDP growth is higher than the US, right? China and India, clear examples. They've charged much higher tariffs than we do, and they're growing much faster. I think that's where the administration is coming from. Like, wait a minute, we are actually growing slower as a result of lower tariffs. So there's a counter argument to make. And then again, there's very negative feelings about tariffs. It's seen as a tax, it's seen as inflation, seen as maybe even geopolitical tool and causing tension. But yet other countries use higher tariffs. So there's something about reciprocity, as they say, to get at least an even playing field to bring things more in balance. So for that perspective, it could be significant. I have always said that the view that if it get implemented the right way, the US economy may end up as a surplus economy, meaning trade surplus and fiscal surplus, which actually leads to high productivity, more investment, what we saw in the late 90s. That could be the outcome of this policy.
So what about the short-term pain? I mean, the U.S. president and the Treasury Secretary and the whole administration has talked about a period of adjustment. And I'm wondering whether you have as well upgraded the likelihood of a recession this year. We heard from Ed Yardeni, who's now seeing 35% instead of 20%. I'm wondering whether you see merit in that kind of view, the negative view, at least initially.
It could be initially the way consumers are responding so far. I mean, these consumer surveys show that people are anxious about tariffs, and they're anxious too because they believe that it could affect employment. And we have other developments that are going on with employment in itself. Whether it's the Doge program or it's just the industries itself, you're seeing some layoff announcements. There's some slower growth overall. So it could be indeed this tax, this pain that we have to accept, because we're going to have to live differently, a different way of trading, different way of how we consume products. At the end of the day is this, that if it does incentivize domestic production and domestic investment, that will be the other side of that story. So I'm more of the camp that, like Powell actually said them yesterday himself, the probability of a recession is always there. There's always a recession around the corner, but it's restored by historic standards. It's quite low. I'm more in that camp. There's always a risk of recession, but I think it's a low probability, so lower than we at Jordanians.
I mean, I can't help but get the impression that the administration is looking to steer a pathway into a recession because of the U.S. debt refinancing that is coming due. Can you weigh into that for us?
Yeah, it's major, the refinancing, no question. And it's very challenging because we are financing our fiscal deficit with short-term interest instruments, mostly T-bills and some other short-term paper. And we have to roll it over. And because of the change of trade policy, right, the reason why foreign countries buy our treasury debt is because we have a major trade deficit. That's part of the calculation. The fact that these trade deficits start to slowly shrink is also why foreign buyers are purchasing fewer treasuries. And it will have to be made up with the domestic base who are a bit torn by this idea, like we're getting potentially high inflation. Let's say we have a growth slowdown. What's that going to do to the yield curve as it'll swing around? So it's a bit of a challenge there. I do think we can roll it over though. There's plenty of liquidity, plenty of ultimate demand, but it may have to be with some volatility. So I think it's that volatility that we're going to see. I don't believe that we're going to have, let's say, failed auctions as people fear. There continues to be sufficient to benefit the U.S. Treasuries.
I mean, there's about $3 trillion of debt that needs to be refinanced throughout 2025. I was looking at a quote from Ray Dalio who says that the U.S. is going to have to sell a quantity of debt that the world is not going to want to buy. You're saying, though, that that's not necessarily going to press the Fed into cutting rates, right?
I don't think that's the incentive, or at least they don't want to make it look like that is the case, even though it may move in parallel to one another. In other words, the refinancing is happening and the Fed is cutting rates because it's looking at the growth outlook. So it may be coincidental that way, but yes, it's not. The Fed is not cutting rates to help the deficit be rolled over. But I do think the Fed takes note of is this debt ceiling, and they've mentioned it, that it has an impact on the Fed's balance sheet, meaning if the Fed continues to drain liquidity out of the system and the debt ceiling that has built up this big surplus at the Treasury gets drained as well, then it can cause pressure on money market rates. And this is the reason why the Fed does pay attention to what happens with the deficit and the debt ceiling and how it could cause volatility in overnight financing, which could affect the economy. So that doesn't lead to rate cuts, but it does lead to the Fed, as they announced yesterday, to start not only slowing down QT, but ultimately quantitative tightening to end it. And I think that's what the Fed will do in response to the deficit.
Was there anything that surprised you about the language that the Fed has used? I mean, there were, sort of subtle shifts, but overall, it kind of ticked all the boxes as far as, the major investors were concerned. I want to hear from you on this.
Well, I think what people were surprised about is that the word transitory made itself back into Fed language, because it was really viewed as something that the Fed has made a mistake with, is to classify inflation in 2021 as transitory. But tariffs are now being put in the word transitory, so the double T word. And the issue with that potentially could be that it isn't, and that therefore there is a risk the Fed may once again have to reverse course and go a different direction instead of cutting rates, having to stay higher for longer or worse, raise rates. So I think that was, to me, the surprise to hear that because we don't know what this tariffs will do. It could be transitory, but there's a lot of uncertainty. That's why we're in this environment currently until they're actually implemented, see how the economy absorbs the tariffs overall, because it's a very complex calculation. As Powell says, they're trying to calculate inflation that's caused by tariffs and inflation that's caused without tariffs. And that's what everybody will do now. Just like we had the core X housing, X service, and that sort of analysis when we came out of the pandemic. So I think from the language point of view, shifting back to transitory is interesting. We'll see how it plays out. If it is transitory, it's a good news. But if not, then we're going to have some tension in markets again.
Which company has sort of drawn a little bit of admiration from you in terms of its ability to deal with the uncertainty? Still early days, but where would you say, you know what, they've managed well so far?
Well, what is General Motors? who are very sensitive to the Canadian border, and as well as Mexico, in terms of auto, parts and trade, have been very creative about maneuvering with their, I guess their strategy and sales and so forth to try to circumvent as much as they can the tariff effect. And I think as an example, it's been lauded as like there's ways of at least managing it, the initial impact. And my assumption is that more companies are going to do that. But the ultimate destination of all of that is that there's going to be more and more incentive being creative, particularly from the administration, to drive GM, to drive Apple, to drive all those big companies back into the United States and start saying, forget about all these creative ideas that you're having about trying to avoid the tariffs. Just produce it here and you have no tariffs, right? And that's the slogan. And I think that will start to play a bigger role, which is what I always thought of, like that's the ultimate bullish outcome of the tariff negativity, is that investment picks up in the United States, maybe just by incentive, by force, which then leads to more productivity, lower prices, and more employment ultimately. And that is the outcome. I mean, that's what they're trying to drive for. And the Fed, by the way, is in favor of that too. But it just doesn't go without pain, and it leads to creativity of companies maintaining their business positions they have and try to circumvent the tariffs for the time being.
When I was watching the press conference with Jay Powell, who is the most powerful central banker in the world, second time round, again, a question on, whether he's worried about the U.S. president retiring him, to put it mildly, right? It wasn't phrased that way in this press conference, but that was clearly the question as to, whether he would see out his term. What is the situation from a legal perspective in terms of the ability of the U.S. president to shorten the tenure? Because theoretically, he should be around until the end of 2026. Do you think he's going to see out his term, or do you actually see the two coming to loggerheads? Because that relationship doesn't look very healthy at the moment.
I think Powell will sit out his term. He said it so much and has repeated it. So I think he's very clear about it, and he does it for public interest, right? It is his role as a chairman to fulfill his duty to the U.S., the American public. And he should do that, in my view, too. Where I think it comes legally, there's a lot of analysis on it. It's not entirely clear. It has to be for cause, right? As in, it has to be an actual case that there's a reason for him to be demoted to governor, because that's how it would happen. He would not leave the FOMC or the board, but he will be demoted from chair to governor. And people cited the two firings that happened at the Federal Trade Commission as a sort of a precursor to what may happen. And the tweet that came out yesterday, right after the press conference, again, criticizing the decision. I mean, it could all happen, Moshe. It's all in the realm of possibilities. I find it interesting how financial markets are not paying a lot of attention to that discussion, because until it actually happens, only then you can judge, right? As in, what would this actually mean? In the big scheme, it's the Federal Open Market Committee. So it's a bigger body where there's others who drive the decision, not just the chair. I think that's what markets have always looked at it, saying there may be this personal issue, but at the end of the day, the FOMC is the FOMC. Until that changes, then we may have to think very different about Fed policy overall. Then I would think that you would see sharper reaction in treasury yields and the dollar, for example. So I think it's more of a ongoing process. I expect that, and as he said, Powell will sit out his term. There will be ongoing debate about it, but he has to fulfill his duty at price stability, maximum employment. And I think that's what he will do.
Yes, and I love it. And I want to build on that, actually, because you've studied the Fed over 20 years and you've seen sort of probably over 100 or 200 of these press conferences. I'm wondering if they were open to taking feedback from you. What would you tell them specifically? What can they do better?
Well, one is the communication in itself, right? Like, as in, you have to take a view on the tariffs, right? You got to really take a view on this policy and how you respond to it. I think that's somewhat lacking still. We're getting too many mixed signals here. The market is currently trading on the forecast from the Fed, is in lower growth in the future, and taking that as like a clear signal. But it's certainly not taking anything from what was said in the press conference. So that's all very mixed sort of picture there. So I think that would be my feedback. Be more clear about what you really think these tariffs could do. You have plenty of economists, right, that can analyze it. They can calculate the tariff with inflation, the tariff without, inflation with tariff and without tariffs. It's very possible to calculate it. So I think you should be clear about it for that reason, because it will be clear to the public that way what you can really do with this, right? Currently, I think the anxiety that exists among consumers is that it's not clear what will happen. And the Fed has a role to play there, because it must guard for price stability. How do you do that? Is by controlling expectations. And by how do you do that? By very clear messaging. So I think that's lacking. That would be my advice to you.
I mean, what I'm troubled by is sort of the clarity of view that was expressed by Stephen Miron. And for our global audience watching or listening, if you haven't looked at the document which was compiled in November, I urge you to take a close look at that document, because you look at what's happening now and a lot of the ideas are in there and they're very clearly laid out. Stephen Miron, now the chairman of the Council of Economic Advisors. Could you break out what you think is the most realistic of that plan? I mean, I'm guessing you had a chance to look at it as well. Overall, it does give a sign that this administration is looking to make huge changes to the global financial system, but not necessarily at any cost.
Yeah, I think that's the main point, and not at any cost. It has to be obviously in the benefit of the U.S. economy. Because if it isn't, then you can follow that policy. I still think it's a blueprint, though, Youssef. I'm not sure if it's all going to be exactly implemented, because you do have the Senate and Congress, right? The House, but the Senate in particular, which will play an influential role on how much of that policy goes to fruition. We know that there's executive orders. We know there's a certain way to go outside of Congress, but not everything can be exactly implemented that way. I'm a little bit neutral in a way. I look at it more saying I'm a market participant, a market practitioner, right? So for now, markets have taken a very neutral stance here about these ideas that Steve Meyer has had, because exactly for that reason, there's a legal structure here in place that just doesn't allow things like plans like that to just be freely implemented without any congressional oversight. Even the tariffs, by the way, have been discussed. In fact, this is essentially a tax proposal and may need then therefore congressional approval, right? And at least there's debate about it, and it should be, because it has to be carefully considered.
I mean, my understanding that tariffs can be imposed, at least, I mean, not obviously domestically, but they can be imposed abroad on other trading partners by circumventing Congress. Is that not you? So you're saying this is still an open debate as to whether he legally has the authority to do that?
Well, yes, the president has the legal authority to do it, because he has used this Emergency Economic Act, the EEAP, it's this act that he enacted in order to make a case for that. I need to follow this trade policy in this direction. But there has been debate in Congress about if this becomes an actual tax on consumers, so to speak, then it has to be congressional. At least has to be congressional oversight or congressional debate. So we'll see if that's the whole transitory debate actually also with the Fed. Right? Is this a tax? Because a tax is something that's more permanent. That's like we place the tax on goods, and that's what it is for the indefinite period until it takes the tax out, right? Take it down. Or is it just transitory? As in, yeah, we raise the tariffs, but they get absorbed and they get sort of like within a competitive process. You don't actually notice anything anymore at some point, right? It's like a virus. It comes up and then the population absorbs it and it's gone, right? It's never gone, obviously, but that's that idea. So I think the congressional oversight is currently more about the debating if it's a tax, but it's the Economic Emergency Act, I believe. Don't exactly the exact words was EEAP, Act that allows the president to enact these tariffs, currently making it reciprocal, at least with universal tariffs too. So I think that's where we're at right now, the legal process.
Yeah, maybe also is a repricing around the uncertainty and around maybe some of these theoretically very safe assets not being as safe, at least in terms of potential valuation loss. So does it even make sense to step into U.S. Treasuries, or should I wait this out? I mean, for investors, maybe just hold at this point, right, until we get past the tariff debacle.
Yeah, I think the market is most vividly expressing that is gold. And it was with yesterday too, right? The Fed is uncertain about tariffs, consumers are uncertain about tariffs, how it will impact, and gold is rallying. That's the safe haven current, right? That's the hedge against the outcomes of tariffs. Could it be stagflationary? Could it be growth slowdown, or all these type of uncertainties, as opposed to treasuries, although they're a little bit lower yield since the press conference. I think that's really about people betting on that. Ultimately, it's a weaker growth outlook and the Fed will cut rates as a result. That's sort of the idea, but it's nothing like what gold has done, right? So I think the market's made a decision that for now you have alternative safe havens. Gold seems to be the primary safe haven at this point.
Can I ask you to what extent sort of the Gulf or the broader Middle East factors into the opportunity set? The Gulf is home to some of the biggest sovereign wealth funds in the world. They're big investors in, well, everywhere in the world, but they're opening up their own markets, Riyadh, sort of Dubai and Abu Dhabi, Doha. I'm wondering, just give us a sense of, to what extent that is getting a bit of debate for potential deployment there in New York, in Los Angeles, San Francisco. Would you say at the moment, really, it's either China, Europe, or US, and sort of the rest is kind of a sideshow?
Yeah, it's that latter. It's a bit sideshow still. I mean, I think you need to be knowledgeable about the specific markets that you mentioned. So I'm not myself an expert in there. I know that there's always opportunity everywhere, right? And no matter what. I mean, if you take just off track here, but take Argentina as a really good example of what's such a basket case that has been for years, and now it's suddenly hugely popular because that incoming president made a change of fiscal policy. Same thing in Abu Dhabi or Riyadh. There could be all of a sudden investor flow coming in because there's an opportunity there. Perhaps the tensions in the Gulf disappear, the investment happened, and that sort of thing. So I think it's more that. I think the big focus still is about, I think particularly US versus China. That's, I think, where the big investor focus is. You have a Chinese market that's very undervalued. You have a US market still relatively overvalued. How that is going to shake out in this trade war that we're having compared to the first trade war, but clearly the US markets were outperforming everything else. We're now seeing the opposite. And I think this is the big focus, I think, currently.
I want to get to a bit of a personal segment. Could you give us a sense of what your investing style is like, if you're able to speak to that?
Yeah, of course. Well, I'm an active investor myself. I invest in US foreign stocks. I do options. I do futures. I do bonds. I do mutual funds. So I do it all. And I do think my own personal view there is in for what I do for my work. It has to align with clients all the time. As I said, whatever you're investing, you try to align with what you do for your clients, because that's the fiduciary way to do it. As an active investor, I look just a similar way. I was allocated more to foreign markets myself too, because I saw the opportunity of I just looked at the valuation differences getting wider and wider, and I thought there is opportunity there, because I couldn't see that if US economy stays relatively on track, why there would be a major contraction, recession, say in Europe. I couldn't see that. I never really thought that Europe would get into a big recession because it's so linked to the US, and China continues to grow at 5%. So I didn't think that for that reason that basically your European markets are undervalued in my view. So that was one thing I looked at carefully. I'm not a speculator. I don't trade intraday because now you have to be really focused on that to make return. I'm more strategic. I do think the asset allocation, if I speak that for myself, is that it continues to be a bit more overweight in equities relative to bonds. The concern I have with fixed income is that the interest rate volatility is very high because of the economies being so in flux, and because the central banks having to react to one direction or potentially can the other direction. So I do think that fixed income is somewhat more of a conservative allocation at this stage. I think you should take a careful look at alternatives, whether it's private equity, private credit, or whether it's even in the venture capital or real estate space, that's a good alternative. That's important to have because of fixed income being volatile.
I mean, I was catching up earlier with Ryan Lamanna. He was saying that he has 15% of his net worth in cryptocurrencies. I mean, I'm guessing you're not quite there yet. Are you more a 1 to 2% kind of guy?
No, I'm on 5% for myself personally, but not 15. But I get this view like that's another alternative in the markets where the market environment has changed and people want crypto. People want to trade it. People want to transact in it. And the central banks, I think, have realized that the technology, blockchain, is an important technology for markets in the future. That's, I think, the fundamental value for me it is. Meaning, if we can be able to implement blockchain in the appropriate way, can you imagine how you could settle securities anywhere in seconds? That all the transaction costs start to decline very, very meaningfully. You think of like, say, illiquid markets in emerging markets as one example. That would be a big benefit to investors. So I think for that reason, fundamental reason, I think that crypto, Bitcoin or any of that is a good proxy for that technology ultimately being widely implemented in global.
So do you have a view on the Bitcoin price then? Or are you just allocating, a percent or you just said 5% and then you see how things go?
Yeah, more like that. Because I think so one thing we know with Bitcoin and it's just a proxy, right? It's gotten so high in price because it's so readily available now to ETFs and people have a view on it. But if you really think of the Bitcoin in itself, you got to be really in that market to understand it. So I think more of the macro view of it. Ultimately, I think that it's not about currencies. It's more like people said it's digital gold. That may be the true definition ultimately. But I still come back to the blockchain technology, which is actually Ethereum. That's really what that represents. But if Ethereum goes up, then Bitcoin goes up. There's this correlation. I think that's for me the big fundamental value for that segment. I think if it gets properly implemented, as I said, then I think it could create some significant changes in how we operate the financial markets. So think about it. We have 24 hours, 7 days a week financial markets globally.
I can't handle what we have already. So let alone around the clock through the weekend. Ben, in terms of the boldest call you've made that worked out in your career, what was it? If you're able to share that.
Oh, in my career, well, I definitely made the call of US interest rates in 2020. Where I say they were unnaturally low.
I remember that.
So we definitely that was a call. I say, yeah, I went for 50 basis points to 5%. That was a pretty major call. I made another call of gold, about a year and a half ago when I was trading below 2,000. I think it was 1,700. That it would go towards 3,000, which we are today, simply because I visioned this inflation uncertainty environment as a fuel for gold as an alternative. It's the best hedge in that environment, I think, better than common stocks for that matter. I guess the other bold call is more about, again, like the longer term trend of interest rates, but that dates back from a major investment management firm where I work with a major investor, where we realized that, interest rates were depressed and there was too much risk in interest rates. I continue to have that view though. I don't think that we're out of the woods. And therefore, I maintain my call of U.S. Treasury yield should actually be more 5% or higher because the reflection of risk as opposed to being at 4 or 3, even though people like to go with, like to be lower, right? And there's a lot of people want to have low risk. It's understandable, but the risks are higher. So I think people will be mindful of the volatility of interest rates.
How high do you think gold can go still beyond sort of 3,000?
I mean, any financial asset you have, there's never a limit, right? That it could go just with
within sort of by year end into 2026, right. What do you think?
Can make predictions in itself. Always be careful with that. I just more think of it like it is an environment where alternative assets are playing a more important role now for investors. That's what I think you can conclude. Can make the prediction how the exact number, but I would just more think of it that if the uncertainty continues where we're in currently, it's only more of a fuel for people seeking out alternatives to the conventional assets like stocks and bonds. Why? Because those assets are lower or less correlated overall. And then people, it's just a traditional finance theory that people do pay attention to. I don't think it's in line by rate to go all back into cash either. That would be where we're getting really like the pandemic, right? Where we had basically this week, 5 years ago, we really didn't know where we were, right? It was just like, there was a completely an abyss situation. We're not in that environment. I don't think that that's the case, even though that cash today pays a much higher interest than it did 5 years ago. And so that's the difference.
Yeah.
So I think for all those reasons, think of alternatives broadly.
You've been working in financial markets, I believe, since 1994. What was the sort of hardest part of that journey? If you look at it longer term, which period would you say, you know what, that was really hard, really tough?
Well, I think the crisis moments of starting with long-term capital management in 1998, when I was just a few years in the markets, with 2008, which was severe, and then obviously the pandemic years later, those were obviously really critical moments, also defining moments of where we are now today. I think also it shaped a lot of people's, outlook and careers, right? So, I think in general that and actually 9/11, I would put that in there too, more personal, there was a very, very, very dire moment, I think, that you had to actually sit there and see that unfolding and actually see people that I knew in New York who were affected by that, right? So these are the kind of moments that they're kind of stay in your mind, in your memory forever. But I think overall that if you take from when I started in the 90s till today, what you can clearly tell is that it's kind of more and more volatile over time. Right? You just take that VIX index as a good parameter of that. You're seeing the trend higher and higher, volatility becoming more and more volatile. I think that's a major change. It's about capital, it's about technology, it's about geopolitics, it's about just generally uncertainties that are becoming bigger and bigger. And I think that's more challenging each year how to navigate that, right? Since it's not that simple. So,
yeah, it's definitely a much wilder roller coaster these days. Both the ups and the downs, and so the sheer velocity of it all. One thing that stood out to me when I was sort of reading through your background, you describe sort of the moment in 1987, right? I think you were 16 years old. Where were you when that crash happened, and kind of what memory did it leave? How did it sort of form your initial impressions of, I guess, markets generally?
Well, one thing that it did to me was that it actually was a calling for me. At that moment, I knew what I wanted to do. As a 16-year-old, and I have a son who's now a little bit older, but he's still figuring it all out. But I had a immediate idea that's what I'm going to do. I'm going to work in markets. So I'm going to do something as an economist, markets. I knew what I wanted to do, which was, I think, really important for anyone. Like if you know what you want to do, that gives you a lot of confidence. Even though it is a very challenging path, because your career evolves and it can be a lot of challenges. What it also showed me was that that was a moment of we had 1929 the crash, but it was so long ago that the ideas of it were like they're very aged. Or by that happened, but 1987 was a very psychological effect. All of a sudden, there was a change of heart that people saw the economy of the U.S. suddenly shifting from something that was a really good economy in the 80s. It was from 1982 into spring of 87. Strong, really bullish economy shifted all of a sudden to something very different. And why that happens, is that people felt they need to get out of their stock holdings for that reason. For me, it was just a very fascinating moment to see markets in action. And it determined my quest of that's what I want to do in my career. And that's why I went to study economics at the University of Amsterdam. And my course in economics was not traditional macro accounting. It was financial markets. It was international finance. And that's what I do still today for myself.
Wow, that's a remarkable journey. In terms of the advice that you would give anybody starting out their finance career or their investing journey, what would you tell them today?
So you can never assume anything, right? That's one thing you have to really be careful with. The assumptions you make are going to change very dramatically in the future. I mean, in the market's career. In other words, like, it's a cyclical industry, right? It does have a lot of movement. Secondly, I think it's also about complexity. When I started out in the 90s, there was already complexity because of the euro changing and all that. When I dealt with that sort of change, and the LTCM was the first major financial shock that happened. I think as new incoming person, you have to be ready that there's going to be very repetitive financial shocks occurring, on a frequent basis with even more and more complexity. Not just because the technology has advanced so much, because it's just a complex environment overall. Not just all the smart investors are in the marketplace, but just everything is changing so quickly. And that's what we're living today, right? There's rapid changes. And so I think people need to be prepared for it. If you enter this career, it's a cyclical industry. It's more volatility, more complexity. But you can be very successful in this industry. If you really know what you want to do, you can make it happen.
That's a fantastic note to wrap up on. Ben, really appreciate your patience and your insights. As always, thank you, my friend. That was Ben Emmons there. And to our audience watching from across the globe, please hit the subscribe button if you haven't yet, so we can keep you up to date with all the latest episodes. See you soon.